SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi e-lecture on Gold as International Reserves, a Barbarous Relic No More. A quarter of a century ago, one of my tasks as a young economist at the European Monetary Institute, the forerunner of the European Central Bank, was to prepare a report for the Foreign Exchange Policy Subcommittee, which should help to decide what share gold should have in the ECB's official reserves. Back then, several central banks were selling part of their gold reserves. This was motivated by several reasons, among which were the notion of gold being no longer needed as a global monetary anchor, the notion that a fiat money needs no balance sheet backing anyway, but also gold's low or close to zero current return and the lure of realizing valuation profits to enhance central bank profits. Our analysis back then regarding the ECB's gold reserves indeed also considered whether gold would contribute to improving the risk-return profile of the ECB's official foreign reserves. But more importantly, some fraction of gold in the ECB's international reserves was also considered to serve as a signal of the euro's solidity and of European central banks' continued commitment to gold as a reserve asset. You can imagine how excited I was when I noticed Barry Eichengreen's and co-authors' recent IMF working paper, which investigates the reasons why several central banks have recently strongly stocked up their gold holdings. And you can imagine how well Omar Zulaica's and co-authors' BIS working paper on what share for gold on the interaction of gold and foreign exchange reserve returns resonates with my long ago work on the contribution which gold may play for central banks' foreign reserve portfolio performance. We are very privileged and happy to have both Barry Eichengreen from the University of Berkeley, California, and Omar Zulaica from the BIS with us today. In addition, Shaokai Fan from the World Gold Council will bring in a gold market practitioner's perspective. Without further ado, I hand over to Barry Eichengreen. Barry, over to you.
Ernest, thank you very much for that, and it's a pleasure to be with this audience and these discussants. As you mentioned, this paper is co-authored with a couple of economists from the IMF. Were they here, they would say nothing in this paper reflects official IMF policy, but that is even more true given that I am here in their stead. So people will be aware that central banks have been loading up on gold reserves in recent months and quarters. So the World Gold Council reminded us recently that in the third quarter of 2022, central banks worldwide added some $20 billion worth of gold to their reserve portfolios, the largest quarterly increase in fully 55 years. So there seems to be a historic break, or as I will argue a little bit later, accentuation of trend. And there's been much excited commentary given that there was a secular decline in the share of gold reserves stretching over the better part of 4 decades prior to recent events. As we point out in the paper, this recent increase in central bank holdings of gold is not quite as unprecedented as sometimes portrayed. Yes, the share of central bank reserves worldwide held in the form of gold had been falling over a period of decades, but this seems to have turned around at about the time of the global financial crisis, as you can see here. So again, this points up the question of what exactly is going on. What are the motives for central banks adding gold reserves in the course of the last decade plus? That is the subject of our paper. Here you can see another portrayal of the same prior to the global financial crisis. The bar for central banks selling gold was taller than the bar for central banks buying gold, and you can see how that relationship has reversed as well around the time of the GFC. We focus in the paper on two potential explanations for this shift. One is a fairly traditional story of how gold is seen as a safe haven, a desirable reserve asset, especially in periods of high economic, financial, and geopolitical uncertainty. Like the period we entered, if you will, around the time of the GFC, and from which we haven't obviously exited. So this story emphasizes how gold can be a useful inflation hedge. It's a portfolio diversifier, and portfolio diversification is especially valuable in periods of volatility. It is favored over other commodities on grounds of tradition, and there are well-regulated markets on which to purchase gold, particularly in London, New York, and Shanghai. So that's explanation number one. Explanation number two is that gold is perceived as a safe and desirable reserve asset when countries are subject to financial sanctions and when financial investments are potentially subject to asset freezes and seizure. So people have pointed to the decision of the G7 plus countries to freeze the foreign exchange reserves of the Bank of Russia, how this was unprecedented in the sense that the United States took this step without classifying Russia as a direct material threat to the national security of the USA, something that previous administrations did when it froze reserves of the central banks of Iran and Afghanistan. So the argument would go that this recent action against the Bank of Russia constituted a wake-up call, a change in regime, if you will. Observers have pointed out that gold vaulted at home is safe from seizure, and they have pointed to the fact that the Bank of Russia had already accelerated its gold purchases around the time of Russia's annexation of Crimea in 2014. Equally, there are counter-arguments to both of these conventional explanations. As for the argument emphasizing gold's role as an inflation and volatility hedge, it can be argued that there are financial securities, that inflation index treasuries, for example, that more effectively provide protection against inflation and economic and financial volatility. Gold prices, pardon me, do move with inflation, but imperfectly, if you will, and gold, of course, doesn't bear interest as do inflation-indexed treasury securities. As for the sanctions hedge argument, yes, gold vaulted at home can't be used gold vaulted at home is safe from seizure, from garnishment, unlike potentially foreign exchange reserves, but it can't be used in currency swaps or as collateral in other financial transactions. To be used for those financial purposes, gold has to be vaulted at the Federal Reserve Bank of New York, the Bank of England, the London Metals Exchange. So gold vaulted at home is safe, but sterile, if you will. Gold vaulted at home is clumsy for use in international transactions. So there are counterexamples, as when Venezuela chartered Iranian aircraft to transfer gold to Iran in payment for oil field equipment and services, but those very costs are kind of illustrate the very point. So in our paper, we seek to first establish which central banks have been diversifying toward gold, and secondly, to recover or at least say something about their motives, to document how the place of gold in central bank reserves has been affected by transactions costs, relative returns, economic and financial uncertainties, geopolitical events, and sanctions risk in particular. We identify 14 active diversifiers. In other words, we define active diversifiers as central banks that have increased the share of their international reserves held in the form of gold by at least 5 percentage points since the turn of the century, and we list 14 such central banks. Interestingly, all emerging markets. So the paper that I'm talking about today is the second in a series. In an earlier paper, my co-authors and I looked at the diversification of foreign exchange reserves. We identified 46 active diversifiers, central banks that diversified their foreign exchange reserves in the direction of non-traditional reserve currencies other than the dollar, the euro, sterling, the yen. There were both emerging markets and advanced economies on that list of 46, and that contrasts with what we find in the present paper. Exclusively emerging markets have been moving significantly in the direction of holding substantially more gold. And of our 14 active diversifiers, it's not hard to point to unusual economic, financial, or geopolitical uncertainties of one sort or another that plausibly provide part of the motivation. So I'm not going to show you a battery of regression tables for the interested. The research paper is online. We basically find that gold shares display considerable inertia. History matters for reserve management. In other words, history is a source of tradition. And central banks are also reluctant to liquidate substantial amounts of gold for fear of driving down the price of their residual shares, and perhaps buying substantial amounts of gold out of worries that they may drive up the price and make it hard to continue with the practice. But relative returns also matter. The gold share of the international reserve portfolio is affected by the future spot price differential, market expectations of returns. It's negatively affected by the U.S. federal funds rate, the return on alternative financial assets. And these last patterns are most evident for emerging markets, which is consistent with the idea that emerging markets manage their reserve portfolios more actively than advanced economies. In addition, we find that the share of gold in international reserves is positively associated with global economic policy uncertainty and US dollar uncertainty. And finally, there is some more limited evidence that the gold share responds positively to global geopolitical risks. We use an index of interstate conflict and terrorist attacks to capture that. Maybe the most timely or novel of our findings looks at the impact of sanctions risk. Fully half of the largest year-over-year increases in central bank holdings of gold since the turn of the century were associated with sanctions risk, the imposition of sanctions in the current or one of the two previous years. And looking at a large sample of countries, we show that sanctions do have a statistically significant impact on the share of reserves held in gold. Multilateral sanctions imposed by a group of advanced economies have a larger effect than unilateral sanctions, which makes sense. Fewer other financial places for which the central bank might turn. While that impact is positive and significant, it's relatively small. So sanctions risk, in the end of the day, explains only a minority, a fraction of observed increases in the gold share in central bank reserve portfolios. So let me show you a few tables and charts that go through those findings in a little bit more detail in my remaining 7.5 minutes. The gold share has been trending downward over time, most obviously since the 1980s, most obviously in developed, advanced economies, which inherited substantial gold holdings from the past and have been seeking to trim those holdings without destabilizing gold prices, although that trend stabilized and has turned around, as I showed you more recently. Developing countries, emerging markets, which didn't inherit large amounts of gold reserves from their past, but which have been building up their international reserve positions since the turn of the century, have been adding gold, and that largely accounts for the stabilization and reversal of this trend. Who holds large amounts of gold in absolute terms? The answer to that question, as you can see from this table, top 20 official gold holdings by country, end of 2021. The answer depends on economic size. The US heads the list, but it also appears to depend on a variety of other circumstances. This is certainly a diverse collection of countries, and the appearance here, the prominence here of Russia, China, Taiwan suggests a role for geopolitical circumstances. Many people will want to see instead which central banks hold the largest share of their international reserve portfolio in gold. And to my eyes, there are some surprises here. I certainly didn't know that Portugal was at the top of this list. And the next time I'm in Lisbon, I will interrogate my friends at the central bank there. I certainly didn't know that there was only one Latin American country on this list, that only Bolivia would feature in the top 20. So Bolivia is very much in the news at the moment, not for good reasons. It's kind of stopped publishing data on its international reserves, which tells you something about its deteriorating financial condition. But one of the things we find in the paper is that central banks of countries that are important gold miners are also important purchasers of gold, maybe to help support that domestic gold mining industry. And gold is now Bolivia's #1 export. Here are the top 10 buyers and top 10 sellers of gold. And the important takeaway is that since the turn of the century, the top 10 buyers have been emerging markets, and the top 10 sellers have been advanced economies, although the IMF is a special case all of its own. And here is the list of active diversifiers, all emerging markets, a number of which have, as I'm putting it politely, distinctive international economic or geopolitical concerns and circumstances. They may be located in difficult parts of the world. They may have difficult domestic politics. They may be engaged in border disputes of various kinds. They may be engaged in disputes with their creditors. You can see that Argentina is among those on this list. We look in the paper at some potential determinants of the share of gold in reserves. And again, I'm not going to do the lots of tables of regression coefficients today. But if you look at this slide, you can see that in the top left panel, time series for economic uncertainty in red and geopolitical risk in blue, And you can see how economic uncertainty has been rising, reflecting the outbreak of COVID and all the and supply chain problems and all that, and that more recently geopolitical risk has been rising for obvious reasons. The top right-hand panel juxtaposes US dollar volatility with gold prices, and you can see that there is at least a modest positive relationship there. In the bottom left-hand panel, the dollar goes up and the dollar goes down, and we do find that there is a relationship there with central bank gold reserves. And finally, there has been an increase over time, especially in the most recent decade, in the incidence and the use of financial sanctions, which we believe is part of the story as well. Finally, we look at conditions specific to the gold market. We look at the bid-ask spread in the gold market, and I'm not enough of an expert on the mechanics of the London and New York gold markets to know why these bid-ask spreads move around in the way they do. So maybe we will get a little bit of insight on that from the commentary about to follow. I think more generally, financial stringency or its opposite have something to do with those bid-ask spreads. We do some time series regressions in the paper, looking at monthly time series all the way back to 1980. We find that there is a lot of inertia in the gold share of reserves. The lag-dependent variable, the LDV, is important. Market expectations of what's going to happen to gold prices, the gold basis, is important. U.S. Inflation is important, as is dollar volatility, and the share of gold is positively associated with global economic policy uncertainty and U.S. dollar uncertainty. And there is some evidence, as I said before, that the gold share responds positively to global geopolitical risk, with advanced countries responding more to geopolitical risk, emerging markets responding more to economic policy uncertainty. So you can use time series regressions to look at impulse response functions, as we do in the paper. Here is the response of the gold share of global foreign exchange reserves to a shock to global economic policy uncertainty, and that peaks after about 10 months or so. It's not a big effect, but it's a statistically significant one. You may worry that all of that is the response of the gold price to economic policy uncertainty, but that is not the case. Even when we look at the volume of gold held in central bank reserve portfolios, it responds significantly and persistently to global economic policy uncertainty. It takes longer to respond because the reserve management committees that Ernest was talking about in his introduction to the seminar have to meet and decide what to do, but the response is there. And finally, there is a response to geopolitical risk as well, although it seems to be less persistent than the response to economic policy uncertainty. We look at country level regressions, 144 countries, annual data, and what this enables us to do is to focus on cases where there is a large increase in the gold share of reserves. Here are the 10 largest since the turn of the century, and you can see that fully half of these are associated with the imposition or risk of sanctions. The word sanctions appears in the last column in half of the cases, and uncomfortable geopolitical circumstances or financial circumstances occur in the others. Finally, I know I've said that once already, but finally, we look at the effect of sanctions on the share of gold in reserves and on the volume of gold held in central bank reserve portfolios, and it is significantly positive. Sanctions in the current or one of the two preceding years. The effect is bigger when the sanctions are imposed multilaterally by the big four reserve issuing economies than otherwise. So there are lots of other control variables in these regressions. We try to be careful about the econometrics here. So here is the volume of reserves, gold reserves held by central banks and how it's affected by sanctions. We can then do the standard thing of decomposing variations over time in the share of gold reserves into their various determinants. The red part of the bar is the response to sanctions, and you can see that it accounts for only a minority of the variability over time. So there is something there. Sanctions risk has motivated some central banks to increase the share of their reserves held in gold, but other things have been larger motivators, from inflation risk to the desire to support domestic gold production to the exchange rate regime. So let me close with 4 questions for the future. Will the even more aggressive use of sanctions that we've seen in the last year plus lead to even more central bank holdings of gold? On the other hand, will the fact that the United States and other reserve issuing countries, eventually even including Japan, will their move to positive interest rates slow the movement away from holding reserves in financial form? Will the development of currency alternatives not subject to sanctions risk further renminbi internationalization and China's build out of its cross-border interbank payments system create other, even more attractive financial alternatives to countries fearing sanctions risk? And if this last scenario comes to pass, what will it imply for the global international monetary and financial system? So I thank you all for your attention.
Thank you very much, Barry, for your thorough and really comprehensive empirical analysis of the drivers of central banks' gold purchases. I think the 4 questions that you put at the end could keep us busy for the next 3 hours. But before we embark on this, we now turn to our second speaker, Shaokai Fan, Global Head of Central Banks from the World Gold Council. Shaokai, what is your experience from interactions with central bank reserve managers? What are their main motivations for reducing, or in several cases recently, for strongly increasing their gold holdings? Over to you.
Thank you so much, and thank you for that kind introduction. Good afternoon, good morning, everybody. Good evening from Asia, where I am right now. It's great to be able to talk to everybody today on this forum and to follow such a well-known speaker, Professor Eichengreen. So I think I'll try to answer your questions, Ernest, but also maybe supplement a little bit of what the professor was saying in his section as well, and maybe break down a little bit more about what's been happening in this specific record-breaking year of central bank gold buying we saw in 2022. I think the professor mentioned the Q3 figures that we published on central bank gold buying last year. Since then, we have published our Q4 figures, so we now have a full year data for central bank gold buying in 2022, and it was a record-breaking year of 1,100 tons of gold bought on a net basis, which makes it the single highest year ever of central bank gold buying since we have records on this. The professor already mentioned sort of the long-term trend. Of course, since the breakdown of the Bretton Woods system, we've seen central banks largely selling gold, mostly Western European central banks, throughout the 80s, 90s, and into the early 2000s. And that trend abruptly reversed after the 2008 financial crisis, where for the last 13 years, we've had central banks largely being net buyers of gold, with almost all of that buying coming from emerging market central banks, leading to the record-breaking year that we saw last year in 2022. I hope that this chart just gives you a sense of the scale of the buying that we saw last year. And just to give you a tease of what's going on now, for the data we already have for January and February of 2023, it looks like the trend is at least continuing from what we can see so far. If we go on to the second slide that I prepared, I think that this record level of gold buying naturally leads to two major questions. Who's been buying and why have they been buying? And unfortunately, neither of these questions have straightforward answers. First, on the who's been buying. So this chart shows all the publicly available information on central banks that were active in the gold market in 2022. So the largest single buyer based on public data is Turkey. The second largest single buyer was mainland China. We also saw a lot of buying actually coming from the Middle East last year, with Egypt, Iraq, the UAE, Qatar, all adding significant amounts of gold as well in 2022. On the selling side, the single largest seller was Kazakhstan. And Kazakhstan is, as the professor mentioned, one of those countries that buys gold from domestic sources. Gold as a percent of their reserves is well over 50%, probably closer to 60%. So since they have the luxury of topping up their gold reserves basically whenever they want, they buy gold from domestic sources, they can take advantage of periods when the gold price is higher to, I guess, unleash some of those reserves and turn it into US dollar liquidity as well. You will see that Russia is on this chart as a seller as well, but there's a caveat here. That data is only from January 2022, before the war started. After the war began, Russia stopped reporting all of its foreign exchange positions, so we don't have any visibility after the war began. That sale that we saw in January 2022 is from a coin program that the Russian Central Bank occasionally does, where they take some of the gold reserves, mint commemorative coins, and sell it to the public. The same with Germany, actually, which was the second largest seller last year. They have an ongoing coin program as well. So those are not strategic sales per se. In Q1 of this year, so January and February, I had mentioned that the trend of strong buying continues. The Monetary Authority of Singapore bought 45 tons of gold in January, and China has continued to report continued buying, with January and February purchases combined to be about 50 tons or so. Most of the buying, as you can see both here on this chart and what I've mentioned before, is coming from the emerging markets. But we do have small examples of some developed market countries buying gold as well. I mentioned Singapore already. It depends on whether you want to consider them EM or DM. But in recent years, we also saw the Central Bank of Ireland adding gold, actually close to tripling their gold reserves, although from a very small base. Which is an interesting case because they're a Western developed market Eurozone central bank, but they too have seen a need to add gold. So that leads me to the second major question in this discussion, which is why have central banks been adding so much gold? The professor already alluded to some of these reasons, but we think that, first of all, gold's performance during times of crisis, gold's apolitical nature have long been major reasons for why central banks turn to gold. And that's actually backed up by an annual survey we do of central banks, where they tell us which factors are the most important for their reasons to hold gold. And gold's performance during times of crisis, its apolitical nature, its usefulness during periods of stress, those typically come up at the top. But I think I would be remiss if I don't mention the elephant in the room, which is, of course, the increased geopolitical tensions and sanctions risk that I think a lot of central banks are now calibrating, analyzing, rethinking, because essentially the nature of political risk has changed somewhat from the world we knew before the Russian invasion of Ukraine. And I think some central banks are thinking about what that means for how they manage their reserve assets and how they might want to mitigate political risk. Now, of course, gold, if it's held in your domestic vault, it could never be frozen or touched by a foreign power, but its usability is limited under international sanctions. With that being said, there are other aspects of gold as a reserve asset, as I mentioned before, its performance during times of crisis and periods of market stress, that I think central banks are also turning to as well. I briefly mentioned the survey. I just want to say that our 2023 survey is currently in the field, and we expect the survey to be released at the end of May this year. So I'm really very much looking forward to the results of that. I know there are many central bankers on the line today. If you've received the survey, we certainly hope you'll respond, because your information helps us to make these determinations on what's happening in the gold market. If we just move to the final slide in my section, I'll talk a little bit about these huge numbers of gold buying we've seen, because the numbers that are being reported are World Gold Council figures. So we actually use two different data sets to generate the amount of gold buying we report on a quarterly basis. We, of course, look at the public data, so what's reported to the IMF by central banks and what central banks put on their own websites and annual reports. But we also use an independent third-party data provider that uses proprietary means to measure central bank official sector demand of gold. They have a variety of different ways they do this, based on customs data, based on the type of bars being bought, where it's going to, etc. But suffice it to say that we have a very high degree of confidence that their data is, at least mostly accurate. And that's also backed up by a lot of the conversations we've been having in the gold market recently. When we talk to gold traders, they concur that the official sector has been this active in the gold market during Q3 and Q4 last year and continuing into Q1 of this year. So as you can tell by this chart, most of the large-scale buying we saw in 2022 was concentrated in the back half of the year, with most of that buying being unreported buying. Now, we can't say who those central banks are, because we will never front run a central bank in reporting. But of course, I think that it just underscores the large amount of demand that there is for central bank buying of gold right now. And we all know that central banks don't necessarily report to the IMF in a timely manner for a variety of reasons. There's always lags and delays. But I think that, that at least might account for some of these unreported purchases. But there are many, many reasons for why central banks may not want to purchase or disclose their gold holdings. So we'll leave it up to them and their wisdom to decide when to report formally their gold holdings, if any. So I hope that was able to shed a little bit of light into what's been happening specifically in the gold market among central banks in 2022. Happy to take your questions during the end, but just one final reminder. We run a training program for central banks every year called the Executive Program, and we're actually happy to be collaborating with SUERF this year, as well as the Austrian National Bank. And this will be an in-person event during the first week of October in Vienna. And we hope that all the central bankers on this call will be able to join us. So thank you very much.
Thank you very much, Shaokai. So it seems your direct interactions with central bank reserve managers broadly confirm Barry's empirical findings. Although, of course, this large part of unreported gold purchases is a particular point which I think needs further investigation. Let me give Barry the opportunity for a first set of reactions.
Well, I think the two of us are in broad agreement. I would reemphasize one thing that I said and showed in my presentation, which is that if you try to quantify the impact of geopolitical uncertainty generally and sanctions risk in particular, you can account for only a small fraction of changes in central bank gold holdings. So that is a new and prominent feature of the global environment, but it doesn't seem to, looking back in time, explain much of the variation we've seen. Inevitably, there's is the past a good guide to the future question. The other thing I would flag is in Shaokai's second slide, the very large share of gold purchases, quote, unreported gold purchases in the last 2 years, that the last 2 years look entirely different from the preceding period. And again, maybe there are good geopolitical reasons why lag reporting and non-reporting have suddenly become that much more important. So you have your proprietary sources of info on unreported reserves. I'm tempted to go off and use ChatGPT Mark IV as soon as we're done here to ask the same question.
Okay. Thank you very much, Barry. Our third speaker, Omar Zulaica, is Senior Asset Management Specialist at the BIS. Omar, you have investigated in detail whether gold in central banks' official reserves can make a contribution to mitigating price fluctuations in central banks' official reserves. What is your verdict? What are your findings? Over to you.
Thank you, Ernest, for the introduction, and also SUERF for the invitation. All right, thank you. So I was struck by your experience of being a younger central banker, Ernest, and I think there comes a day in the life of every central banker where they ask questions like the ones on the screen. Can gold diversify FX reserve portfolios? What's the right amount? And a question I asked on my paper besides these two is, how does this contrast with real life? And I think we've heard a lot from the other two speakers on this matter. So if we take a practitioner perspective, we can think of putting ourselves in the shoes of a reserve manager who's trying to figure out if what's the appropriate share of gold to hold. And what I'm going to do here is use a model fixed income portfolio. And it's going to be composed of SDR government bonds. According to the IMF data, this is an okay assumption. From experience, we know that these portfolios tend to be low duration. So we're going to assume 2 years of maturity. And finally, just to make things simple, I will assume there's no FX risk. And what we'll be doing is an experiment of combining this portfolio with portioning gold. What portion? Well, I'll vary it in long-only positions, only going from 0 to 100%, and we'll see what combination gives which level of risk or return. And then maybe we can ask questions such as, does this make sense? What's the best share out of all the options? And we can draw some conclusions. So the chart on the screen is showing us the results for volatility. As you can see on the x-axis, we're talking about the gold share in the reserve portfolio, which goes from 0 to 100. 0 means there's only fixed income, while 100% means there's only gold. And then on the y-axis, we've got the total volatility of the portfolio with some confidence band. And what we see is what appears to be basically monotonic function, right? It's almost always increasing, which translates into the conclusion that whenever we add gold to the reserve portfolio, if the fixed income portfolio looks like this, then gold only tends to increase volatility. Now, we can actually zoom into this result, and that's a chart on the right-hand side. And we're just narrowing the axis all the way up to 20%. And you can see that actually there's a small dip, right? And this is what we want to see when the point of the exercise is to reduce risk. And to be very specific or precise, the minimum of this function, the total volatility of the portfolio, is actually reached at 1.35%. So in brief, what this means is if reserve managers was looking to minimize risk in their portfolio, they would find under these assumptions that 1.3% of gold would be appropriate. So maybe not great news, but at least it validates that the market risk profile of the metal is actually very palpable. This should be no surprise. Now, we did run this exercise for many other measures. And let me explain this chart on screen to you. On the x-axis, we have, again, the gold share in the reserve portfolio. But now on the y-axis, we have one of many measures. We talked about volatility, which happens to be the first row. And you can see that the bubble next to volatility is this 1.35% optimal share. Around it, there's a confidence band, which shows that maybe the gold share could be all the way up to maybe 3.5% in order to be appropriate to minimize risk. And then we run the same exercise for other measures. Tail risk, like value at risk or expected shortfall, probability of loss, or return measures divided by risk, which are the last two on the chart. And really, the point here is to try and see what in general the results tell us. What's the appropriate share of gold? Of course, from the return angle, it would be what's the highest level attainable for that measure, but for risk, it would be the lowest. And it's no surprise, again, that when we look at the axis, we see that most bars, the confidence intervals, end right below 6%. Now, this is only theoretical, right? The results can be contrasted with real-life world shares, which are now appearing on screen. When we look at the total amount of gold held by emerging markets, advanced economies, or the world altogether, we see that they land on very different parts of the spectrum. Advanced economies tend to hold together about 19% of all of gold as percent of reserves, emerging markets about 5%, and the world about 7%. I believe these results provide some evidence that emerging markets may think more actively about their share of gold. And this actually ties in nicely with results from Barry's paper, at least in two fronts. They find that when looking for countries that are so-called active diversifiers, there are 14 of them, no advanced economy makes the list. And in addition, when analyzing the results coming out of the regression, which explains the share of gold, they do see that the statistical significance is mostly driven by the emerging market subsample. So this is, I think, a very nice way to validate that perhaps emerging markets, which are closer to the quant optimal side of things, may be thinking about it more proactively. Now, to answer whether our results align with reality, I'm just looking quickly at the cross-section and the time series. The right-hand side chart, which is the time series, should not be new to you. The left-hand side is simply a density function showing one picture of how gold shares are distributed across central banks and governments. And you can see that if you take the average of this distribution, you do find a small number. So the share of gold is low. But really, how central banks choose a share of gold is widely distributed. So there's no, I would say that perhaps an average may be unfair to summarize their behavior. And the right-hand side shows precisely the phenomena that Barry was describing of inertia, that a gold share tries to remain at least very close to its past value over time. Just to wrap up, I guess I want to go full circle here. I review why it is the case that the quantitative approach that I'm using does not necessarily coincide with real life shares of gold. And I think it is difficult to explain these only using a market risk perspective. One needs to think about other kinds of risk, for example, political risk or geopolitical risk, yes, or economic policy uncertainty, as Barry has touched upon. And I think these are the important points, or my favorite ones, at least, from the paper that was presented just a moment ago. Here are some arguments. In fact, they have been reviewed now. Gold is viewed as an asset that's durable and largely imperishable. That's the first. Gold kept at home is not subject to political manipulation. Gold is believed to be to serve as an inflation hedge, even if over long periods of time. And the last one with the chest is really there's some recognition that there's potential value in highly adverse scenarios. And these notions, I think, are hard to support using the quantitative approach, right? So it's very nice to see the effort being put into deriving an empirical result that illustrates them. So for example, and I'm glad to show the impulse response chart, when analyzing the responses to the global economic policy uncertainty, Barry and company find that a shock on this front increases the gold share over like a multi-month period. And the result is similar when you look at geopolitical risk, even if it's a little bit delayed. Now, they do talk, though, about periods between 7 and 12 months, which means that goal decisions and implementation do take time. And we must keep in mind, in fact, that the results that were derived on that paper are using the global aggregates. Because in practice, central banks, individual central banks, combine both qualitative and quantitative angles when making a decision, which angle is more important, of course, varies by region, by economic uses of reserves, the investment horizon, and many much other portfolio characteristics, such as the numeraire, which really lands us in the conclusion that any decision of gold share or gold investment is non-trivial. And I would like to end on that note.
Thank you very much, Omar. for this very, very nice exercise. So I think you put a lot of work and thinking into it, and it really supplements very nicely the points made by Barry and Shaokai. Let me give again Barry the opportunity for a second set of reactions. Barry.
So my main reaction is to echo what you said, Ernest, about how the various presentations today have complemented one another very nicely. One thing that Omar said correctly was that our impulse responses tend to be based on estimates of global aggregates, but the last part of the paper in principle provides a basis for looking at how different groups of countries in different specific circumstances respond. And maybe I can ask a question as well. Do you think, Omar, your results would be different if you looked at a broad basket of commodities as opposed to looking only at one, gold?
Thank you. Yeah, I absolutely agree. I think that parting from the assumption that adding more commodities would diversify the thing to be added to the fixed income portfolio, we would see more support for a commodity tranche, let's call it that. Yeah. In fact, there's if you take a look at the paper, I conduct a little bit of a bunch of experiments, and I vary the numeraire, for example. Not all central banks are dollar-based or SDR-based. And when you look at countries that use a local currency, for example, as a numeraire, then things really go upside down. Perhaps a lot of gold is optimal. And this is not even considering the liability angle, right? It's an asset-only view. So really, I would say the results would certainly change here in the dollar case. Hard to say what happens when you change the currency numeraire, for example.
So we have, I think, two questions from the chat. One is by Bob McCauley.
Barry, I think you had a graph that showed that there was a negative correlation between the dollar's exchange rate and the price of gold.
I would have to go back and look, Bob.
Okay, well, I think this is related to Omar's numeraire point. And my impression is that the gold price goes down in dollar terms when the dollar goes up against other currencies, which implies something like the price of gold is more stable in euro terms than it is in dollar terms. So it probably matters sort of where you are, if you're using the domestic currency as the numeraire, where you are between the dollar and the euro, just what the risk return properties of gold are. So I would suggest that might be integrated into the analysis somehow.
Agreed.
I can offer two further points from the chat. One is from Thomas Widlak, and it reads like this: may the database from the quantitative study, I suppose it's Barry's study, but it might also be Omar's study, may be biased in terms of political stability and the assumptions of no FX exchange rate risk. It would be great to quantitatively analyze risk and return of gold allocations in terms of data from the 1910s to 1950s and in the 1970s. And I also have a question to Shaokai, which ties up to the point on the unreported holdings and purchases. You mentioned that in Q4 of 2022, a substantial estimate was for unreported buying. How do you more precisely estimate these unreported purchases? So maybe I start again with Barry.
So I do think a longer term historical look at these questions would be very worthwhile. You take me back, Thomas, to some of my very earliest scholarly work where I did look at central banks' decisions of whether to hold gold or foreign exchange in the 1920s and 1930s, and how financial instability led to the liquidation of foreign exchange reserves worldwide after 1929. There was a big increase in the gold share then, driven mainly by financial volatility. But yeah, maybe I should go back and redo what I did in the 1980s.
Just to add, I think I see actually the point of the question. Although I guess even if we are in a period or in the sample, a period of political stability, so to speak, everything is relative, right? So it's not like the index is a flat line. So this non-stationarity of this time series will be passed on, even if we're just looking at this sample, right? So I think it has merit nonetheless.
As I mentioned, we use an outside source to estimate the levels of not just central bank gold buying, but our quarterly report talks about all sorts of gold demand, jewelry demand, investment demand, etc. So this external source is called Metals Focus. It's a company that we contract to identify gold demand and supply around the world. So it is proprietary, so I don't have full visibility of how they do it. From my understanding is they look at things like customs data, both import and export data in certain countries. They have on the ground contacts in key markets that can give them information about the direction of gold flow, where that gold is going geographically. We know that central banks have a certain tendency to buy specific bars. So whether it's almost always going to be the LGD, the large bars in a central bank's case, the London Good Delivery bars, I should say. But also there's certain manufacturers, certain refiners that central banks tend to prefer. There's certain, I guess, buying patterns that we sometimes observe the central banks, for instance, preferring sequential bar numbers. But this is all stuff that Metals Focus does on a proprietary basis. So even I don't have the full gamut of what the proprietary information is. But I will reiterate once again that their data has our full confidence. We definitely challenged them on the data when it came out, just because it was so big for Q3 and Q4. And then our conversations in the market seem to back up that this level of gold buying by central banks is correct.
Thank you very much. So this concludes our SUERF Baffi Bocconi e-lecture on gold as an international reserve. A barbarous relic no more. Take along that the main motivation for several central banks worldwide to sharply build up their gold reserves recently indeed also includes rising uncertainty, economic, but above all geopolitical. Let me give a warm thank you to our speakers, Barry Eichengreen, Shaokai Fan, and Omar Zulaica, for sharing your important insights with us, and to all of you for your interest and participation. Bye-bye and take care. Have a nice evening and have a nice morning, Barry.
Bye-bye.
Everyone,
Bye-bye.
bye-bye.